Good morning, all. Thank you for joining us today on our webinar. And we are just seeing a couple of people still joining us right now. So we'll give them another 2 to 3 minutes and then we'll begin. Good morning, all. Thank you for joining us today on our webinar, Common Questions, Uncommon Answers, the VRDDHI way. Today we have with us Mr. Rohit Balakrishnan and Mr. Rajat Setiya. They are the co-fund managers of VRDDHI. I invite them to begin the session.
Thank you, Poonam. Good morning, everybody, and thank you for spending your Saturday morning with us. So today in this webinar, we'll cover a few questions which we often get asked, and which we thought are pertinent to sort of share our perspective. So we dive into the presentation now. So if you move to the next slide, so typically the question that everybody asks is volatility is equal to risk, right? Could we move to the next slide? Yeah. So typically volatility is assumed to be risk, right? So let's see, is this true? Right. So typically now volatility is what? Volatility is, we measure it by stock price, the stock price in general. So let's look at some of these stock prices and let's see, is it volatility is equal to risk? So if you go to the next slide. So this is a chart of a company which probably all of us are aware, and we use their products and use their service on a daily basis. You see the stock price went up, went down, and again trying to go up. Probably investing in this company is risky. Let's see. The name of this company is, uh, let's see what's the name of this company. Right. So Amazon, this is probably, it was briefly one of the largest companies in the world in terms of its market cap. But you can see over a 3-4 year period, the stock price has been extremely volatile. But is this equal to risk? Not sure. Let's look at another chart like this. Again, probably one of the largest companies in the world, a ubiquitous service. I think we can't live without this company in today's time. Again, stock went up, stock went down, again trying to go up. Is this risk? What's the name of this company? Yeah, so again, right? So the point that, and these are two global examples, probably in the top 5 companies in terms of market cap in the world. Now let's go closer home. Let's look at another couple of slides. So probably one of the most loved slash hated stock in the Indian markets. The last 1 year it's been most loved. The previous couple of years it was most hated. So this is a company which I think most of you would have figured out the name by what I just talked about. Again, stock went down, stock went up. If this is the only measure of risk, probably not the correct measure in my view. So what's the name of this company? Right. So now let's take one more example and then I'll talk about what I wanted to convey. Again, an Indian company, probably one of the most phenomenal companies to come into the Indian markets in the last probably 15, 20 years. Very well run, extremely good business model. But look at the stock price, right? Did very well and now again somewhat descending, right? So is this really risk? So what's the name of this company? This is Page Industries, the operators of the brand Jockey in India. So what I really wanted to cover is like the stock prices which are volatile, and these are some of the big companies in their respective. I mean, Alphabet, Amazon, they are the biggest in the world. ITC is one of the biggest companies. Page as well. These are companies where you would say that if you just generally talk about their business, what their characteristics of their business is, their competitive advantage, you would probably not think of them as risky. But if you look at, if I mask as we did, if we mask the name and we talk about the stock price being volatile, we've seen they are as volatile as any other company, right? So just because the stock price is moving up and down, that is not risk. That is what our perspective is. So the point is that if you're investing in the markets, volatility is part of the ride. It's not a bug, it's a feature. So it is going to be whether you invest in the largest companies, as we saw, or whether you invest in small caps, as we do. This volatility is going to not be something which you can get rid of. It is just part of the system. So then, if this is part of the this is what you get as part of the ride, what do you do? So how do you navigate these sort of tough waters or choppy waters? So if you move to the next slide. So we believe whether equity investing in general, and especially in small caps, is the part of the market that we focus on, you need to have a very rigorous process You need to really control your risks. You need to have a focus on how do you really think about risk and what's your framework around risk control. You need to have obviously a long-term horizon, and then you need to have a realistic expectation. If you're investing in the small caps, you must not think that it's something where you just go in and double your money in a year or two. That's not what happens. You must think about this as a realistic expectations, and you should not think that it's a get rich quick scheme like how it is touted to be when the markets are good. So let's talk about what is our investment process and how we control risk, as we'll talk about in the next couple of slides. So we focus on companies which are sort of undiscovered, under researched, and not really owned by the institutions. But these companies are essentially market leaders in their domain. So they may operate in a specific niche, and in that niche, they are either number one, number two, or number three. So the companies that we like to back in, those are there in our portfolio. They are market leaders in their domain. So almost two-thirds of the portfolio, if we look at today, are companies where they are clear market leaders. We want to stay away clear from debt, because if you don't have debt, you have one less reason to go bust. So if you look at the portfolio that we have today, I think about 70% of the companies are actually cash rich. So there is no question of having debt, but they are cash rich. The other point is that we spend a lot of time in trying to understand more about the people who run the business. So backing companies which have high corporate governance, that is something that we lay a lot of emphasis on. Again, the point that I've talked about, these 3 points, if you really think about them, again, we are trying to back very good businesses which have low risks of going bust by the virtue of their balance sheet, and which are run by capable, honest, competent people. So we are trying to that's our risk mitigation process, and buying these companies at a price which looks fair to us, from where we can make good returns for ourselves and for our investors. So this is our overall investment framework. Now, if you look at some of the way we sort of look at, if you go to the next slide. So if you look at how do we know, I mean, to uncover this is the part of is where we spend a lot of time. So this is the overall framework, but how do we go about finding or establishing whether the company that we want to invest is a market leader? Because as I said, these are all undiscovered names, so you don't really you will not probably have heard these names of the companies in your normal course of your life. So we spend a lot of time going through the public collaterals, like reading annual reports, talking to these companies, competitors, uh, suppliers, customers, people who are in the value chain. Also speaking to people on ground, as I said, like dealers, distributors. We spend a lot of time just going through the books of these companies, so annual reports. So by virtue of them being public, a lot of available information is there. So we spend a lot of time visiting these companies, looking at their plants, attending their conference calls, attending their AGM. A good part of our job is to be on the road, and sort of meet companies. We also try to see patterns, how other industries have evolved, how other industries have, so for example, how a new industry in India, let's say electrical manufacturing, how that is getting set right now. The ecosystem is getting set. Probably similarly, you could probably see another manufacturing industry which was look at how that industry has evolved over the last 20-30 years. Was maybe auto ancillary is one example, which started its presence in India in 1980s, and over the years has become a global industry to reckon with. So you try to look at, you try to read a lot, you try to look at other business models, you try to look at business models in other countries, and then you try and make an assessment about the company, the people. And by doing all this work is not just at the time of entry. This is an ongoing process that you keep doing as you keep tracking the company. So it's not just a one-time process and you do it and you forget it. You keep adding to your own repertoire of knowledge, and over a period of time, you are able to make judgments about businesses, about people, and that's what we do. So this is our overall process. But the fulcrum or the bulwark of this process is underlined by the things that I talked about in the previous slide, which is backing a very good business, backed by strong balance sheet and very good people, and buying them at fair prices. So if you move to the next slide, so so again, the entire approach that we talked about is to ensure that how we are managing risks, right? We started with this point that we showed a few charts which were going up and down, some first up, then down, some first down, then up. So clearly, in our view, volatility is not risk, right? So we feel that there are few. So when you're investing in a business, because eventually when you buy a stock, you're doing just that. You're buying a fractional ownership in that company. So you are investing in that business. So when you invest in a business, you are definitely going to take some risks that cannot be wished away, and that you can never bring the risk down to zero. Every business will have risk. So you need to manage or control your risk. So we are not saying that we are not taking any risk. We are taking a risk, but we are going to take risks that we want to, which we think we can, we will be okay to live with, and we want to avoid risks which we can be completely avoided. So what are those risks? For example, you got poor corporate governance. We can ex ante know many times that this company has poor corporate governance, so it's better to avoid them completely. Poor business quality. Many times, history is a good sort of a view. It tells us a good view that if the business is good or bad. Um, so you avoid poor businesses. Whenever the valuations are expensive, you avoid them. Some we are taking the execution risk. As I said, there are businesses which when you invest, you are going to take some part of execution risk. Volatility in stock price, as I said, is not a risk in our view. And low liquidity. So again, this is something very peculiar to small caps. So yes, we have to be very careful in terms of when we buy these companies in terms of execution, and also when we sell. But what you've seen is when you tend to go right in some of these names, uh, liquidity always gets created automatically. So liquidity, if you are right, liquidity doesn't become a problem. Yes, if you're wrong, then liquidity can become a challenge, and that is some risk that you are taking in the as a part of your investment in the small cap space. If we move to the next slide. So this is for a client. So what we do, we don't follow a model portfolio approach. I think we have. I think there was supposed to be two slides, but I'll just talk about one slide here. This is a client who entered in May 2022. Let's jog back to May 2022. We had war breaking out in February or March of 2022. The markets kept moving down. So our deployment was very aggressive, probably the most aggressive in the last 2+ years that we've been managing money in the PMS. However, if one was to look at, let's say a year back, let's say May 21, when a year prior to this chart, May 21 is where we almost a year to deploy money in the account, in a client's account that started. So in this case, you have this slide which shows that it was a very accelerated deployment because the markets were favorable. Whereas in the case that I just mentioned in May 21, we took almost a year and we deployed only 50% to begin with. So what I want to say is that you can manage some of the risks by deploying cash depending on the availability of opportunities that you have. We don't follow the model portfolio approach wherein the client gives us money and we deploy it on day one. That's not what we do. So in our repertoire of managing risks, one is obviously what kind of companies we buy, how we buy. In the how we buy is again the valuations that we pay, and also the the gradual deployment of money that the client gives us, depending on the market condition. This is an example where the market was very favorable and we deployed very quickly. All this. So if you go to the next slide. All this is sort of visible in how we performed at a time when the markets were very sort of choppy. So if you go back a couple of months, March 30th, 31st of March, or around that time, the markets were not in a very favorable situation. So the index was down almost 13%. However, because of the way we operate, because of the way we go about deploying money, because of the kind of companies that we invest in, we had done well. So if you see the Nifty small cap was down by I think about 13%, and we were up around 7%. So again, the point is that if you really look at the way we operate, we have been, and this is not something which just happened. Every time we have seen, whenever there are markets have been down, these portfolios have done extremely well. Now, when I say extremely well, what I mean is alpha generated in a down market is much more valuable than alpha generated in an up market, because if you protect your capital during a bad time, then in a good time it is very difficult to not make money, because by the nature of the markets, a rising tide will lift all boats. But when the markets go down, then at that time, if you are able to protect your capital or lose much less than the market, then I think that is the seed for from where the alpha will get generated. So in this case, obviously we've done, like, we've significantly outperformed. Like, market is down, as I said, 13-14%, and our portfolios were up 7-8%. But even, let's say, in a hypothetical scenario, if the market was down 15% and you were down, let's say, -2, -5%, that also is a significant amount of alpha, because that is what will generate when the market goes up. As you'll see in the next slide, you'll see that it is very difficult to not make money when the market goes up, right? So this was the performance, as I said, in 6 months. In If you go back to the previous slide once, so just happening. This is a conscious strategy of controlling the risk, what we want to do, what kind of risk we want to take. That is what, and how we go about deploying money. That is what we define. I mean, that is what defines this result. So if you go to the next slide, so this is now, I mean, the last 2 months have been phenomenally good for the markets in general. So Nifty small cap, I think, is up about around 15%. We are up around 41%. So again, so as I said, the overall market, it becomes very difficult to not make money when the markets are in such an uptrend. But what we focus on is really buying, very judicious kind of buying, focusing on the kind of companies that we buy. And because of our judicious and very focused kind of buying, we pay a very strong hit to entry valuations. So we've done fairly well, but I think the overall point that we want to sort of give credence to is that volatility is necessarily not risk. Is what you can measure is necessarily not something that should be measured. So volatility can be easily measured in terms of statistical performance, but risk is something different. Risk is, what is this business all about? Risk is, what price should I buy this business? Risk is, who am I partnering these people? Who am I partnering with eventually, who are running this business for me? So it's a very nuanced question, and it should not be just mirrored by something which is easily measured, which is the stock price. And we focus a lot on managing that risk. That is what our overall focus at Vidhi is. And we believe that if you are doing that part well, then over a 3, 4, 5 year period, the overall portfolio should do fine. And that's what has happened in the last couple of years. So if you move to the next slide. So coming to the next part, right now, given that volatility, as I said, is part of the game and you can't wish it away, how do you really build conviction? So we'll talk about one case study which has done really, one company which our investment in which has now been almost close to 5 years, and still we hold on to this company. It's one of the largest position for us. The company called TD Power Systems. So we started tracking this company in 2015. We tracked this company for 2-3 years and then eventually invested in 2018. So why I wanted to share this brief point is, if you go back, if you sort of look back at the process slide, right? As I said, the process is not that only at the time of buying. It's a continuous process, right? We started tracking a company 3 years prior to buying it. So that gives us the kind of comfort or the kind of already understanding about the business, right? So this company is into the field of they make generators for AC generators for companies which make captive power plants and a host of other things. They are a market leader in their area of operation. So again, going back to our investment framework, so this is something that we focus on. It The balance sheet at that point of time had zero debt. Then they were net cash. They had about 100 crores of cash in their books. So again, the second point. So this business was a single product, single geography company back in. So it IPO'd in 2011, and since then, the business underwent a significant challenge because it was focused on domestic markets. The domestic markets went through a significant decline because the capex cycle in India was going through a very bad phase. The company, because it was cash rich, it survived, and in this time it used its resources to develop new products and enter new geographies. So they focused their efforts to tilt their business from 90% domestic business and 10% exports to 60% exports and 40% domestic. So this was what was happening in the business when we started to track it. So we invested in 2018, as I said, and the stock price was flat till about January, February of 2020, and then we had COVID. So we started with a 2% allocation, and we kept on adding to our allocation as we got more conviction and more understanding about the business between 2018 and 20. And then obviously COVID happened, and nobody was spared, and the stock went down by 50%. So let's just go back to that time and just let's for a minute imagine you invested in a company at X. You've not made any money for 2 years, and then you have an event like COVID where you don't know what is happening to entire world. The stock is down by 50%. What do you do, right? So because of all the understanding that we were able to develop and the kind of balance sheet and the market positioning that the business had, we were able to have conviction in this company, and we kept on buying and increased our position. So from 2% beginning of our at the time of starting our position, we increased to 10-12% in terms of our cost. And then obviously the business has performed immensely. So at the time of investing, it was about 400 crores, just about making money, to now close to 15% EBITDA, close to 100 crores of PAT. And the stock price is also sort of gone and sort of mirrored that. But the point, I don't want to focus too much on the output, but I want to focus on what went in to go and keep on backing this company when the external environment was so difficult. You didn't have any support from the stock price, etc. So stock price was never the focus for us at that point of time, and it is never the focus even now. Over a period of time, the business performed. That's where we want to focus on, and the stock price is ultimately a slave of earnings. So that will also start showing up in the numbers. Maybe sometimes belatedly, maybe sometimes ahead of the curve. But you need to focus on the business. So if you now move to so this is how we built conviction. This is what we wanted to sort of encapsulate and show how do you really develop. And this you can do in many, many names when you invest. And this is what the process that we follow. Now, the last question, and then we can move to some Q&A. This is the question that everybody likes to ask, and probably the most oft asked question is this the right time to invest in the markets? Is it the right time to invest in small caps? So clearly, the last 60 days have been pretty eventful in the market. FII buying has been extremely strong. Markets are just a shade away from their all-time highs. And honestly, it's very difficult to say anything about how the markets will do in the next 3 months, 6 months, 1 week, 1 year. Nobody knows. But we have a couple of slides which are long dated, which sort of just give you some flavor of the broad temperature of the market. And this can obviously, it's just a broad indicator, and we don't give too much credence to it, but it's a good sort of, you just get a sense of where you are in the cycle. So if you move to the next slide. So typically, small cap is something which is associated with multi-baggers. This is the line chart is what you see is the Google search trends term for Google Trends for the term multi-bagger. Clearly, if you see, I mean, in hindsight, obviously, but it is very prescient. 2021 was the market peak. That it shows that it peaked around that 2017 similarly. So now clearly we are nowhere close to that, and we are sort of that interest in the market is sort of not that very high even now, even despite the fact that the indexes are at their highs. Um, if you move to the next slide, this is something that we look at, which is this is nothing very high funda, but your Nifty Small Cap 100 index divided by the Nifty 50 index. This is again almost a 20-year long scale chart. We peak around 0.8, 0.9, typically 0.5 and below is a good time. We are at 0.54. Right now, the thing about this data is that everything is doing well right now, large cap, small cap, mid cap. So maybe there is some sort of a dissonance there. But again, it's just a point of reference. When you look at 20-year data, you get some flavor. So this is what the data says. More fundamentally, I think if you go to the next slide, I think this is more important. Um, I mean, if you look at and this is sort of mirrored by we've had result season almost now culminating now. It's been a very strong result season across the board. And in general, if you look at the setup for the Indian economy as such, we are doing quite well. And a lot of the factors are in our favor after a very long period of time. So whether it is the banking sector, which has gone through a very large period of struggle in the last 6, 7 years, one crisis after the other. Banks' balance sheets are clean, corporate balance sheets are clean. So we are at the bottom of the NPA cycle. So there is a lot of credit growth that can happen. Uh, on the other side, there is a very strong push towards infra development, towards capex creation. The government is giving a strong push towards that. A lot of new infra is getting developed, whether it is railways, whether it is roads, whether it is defense. All these things are happening right in front of our eyes. Plus, there is a clear push towards more manufacturing. And the global environment is also supporting with geopolitical issues, with more people wanting to broaden their supply chains. So we feel all this will help some of these companies which we focus on. These are all leaders in their category, so they will be able to gain market share. So it's probably the best outlook for India's manufacturing since independence, probably one of the best periods for Indian banking in terms of their balance sheets. And the fact that all this will lead to people getting more jobs, people's income growing, and a lot of consumption. Anyway, India is a consumption-driven economy. So we will further see those benefits. So more brands will be created, more new age companies will come. So these are all opportunities for people who are seeking, for people like us who are looking to partner with such names when they come to the listed market. Some of them are already there. So in general, we are nowhere close to a hot zone, even though the market is at a sort of all-time high types level. But it's backed by very strong results and a very strong fundamental factor as well. If you look at, as I talked about. So as I said in the beginning, we don't know whether it's a good time. What we've seen is, in general, that timing the market is sort of futile. So it is best to sort of decide that you want to invest and then give yourself that long-term horizon and let people who you think have a process and are capable of managing the risk, let them take that call. So yeah, I think uh, that's all I wanted to talk about in this section. I think we can move to the next slide, and which I think is the last slide. So what have we done? We started our PMS in May 2021, and it's been sort of a up and down kind of a market. So we've done fairly okay, but I guess, as I said, it's still very early. We look at 3, 4, 5 years. But we've done fairly okay so far. So yeah, that is about it from our side. I'll be happy to take questions. Rohit, Rajat, and I are here, so we can any question we are happy to answer.
So our first question is about the fee structure. So anybody willing to ask a question, please type in the chat box and we'll take every question one by one. So the first question is about the fee structure. So on a fixed fee basis, we charge 1.5% on an annual basis, which is charged on a proportionate basis on a quarterly basis. This is the fixed fee, and then we have profit share, which happens after the 8% initial hurdle rate, and the profit share is 15%. There is a high watermark which compounds, and that's the key aspect of our fee structure. High watermark is something that basically ensures that there is no double eating of the profit. There is no profit share happening on the same pool of profits. And when we say it compounds, that means what ultimately it results in is that the hurdle rate, which is 8% at the beginning of the relationship, it goes on increasing as and when we take profit share. So this is about the fee structure. If you need more detail and want to discuss it, you can get in touch with our team and they'll be happy to explain you.
So yeah, ticket size is 50 lakhs. That's correct. Next question is position sizing. Uh, so So I think I did touch upon it during my conversation about TD Power. So we started with something, a small allocation, and let our conviction drive our allocation. So so we moved from 2% to 12% or 11, 12% over a 2, 3 year period. So that was something that I talked about. But overall, I think conviction will drive our position sizing. Whenever we look at a new company which we've not tracked for a long time, we start small. In general, we start small and then let our conviction then drive. We are not averse to being concentrated, but it should be driven by the business performance, our own understanding about the business, and how comfortable we are with the kind of people who are running the show. So yeah, that's how we look at it. Rajat, you want to add anything?
Just one very small point. I mean, it's been 10 plus years to both of us that we have been in the markets. Sham has been in the markets for more than almost 30 years now. So we have a lot of stocks under our watch list that we have been tracking for a fairly good amount of time. However, still, despite that, there will come stocks which are new because lot of new IPOs come every year. So, position sizing also is a function for how long have we been tracking a company and how well understood that company is for us as a team. So, a company that we really understand very well, we may end up beginning with a slightly mediocre allocation of 4, 5%, let's say. And a company which is fairly new, we may want to begin very small and, as we develop comfort, like Rohit mentioned, we'll scale it up.
So I think hurdle rate should be BSE small cap by 8%. Okay. I think Rajat sort of mentioned it in when you were explaining the hurdle and our fee structure. So maybe I would urge you to maybe speak to one of us or one of the advisors. They'll probably help you understand this better. But I'll just try and explain. So this 8% could be a misnomer. So let's say in our fee structure, for example, if you start, let's say, with 100 and it's, let's say, in a given year, it's been a good year, let's say you make 40-50% return, and it can happen given the way the markets are. So let's say you make 50% return in the first year, so 100 becomes 150, right? And your hurdle is in the first year 8%. So the excess of that, which is 42 rupees, on which you charge 15%. So let's say, for the simplicity's sake, let's say 6 rupees is what you charge. So the next year you start on a base of 144. For this year, to be eligible for us to be eligible to get profits, we need to make 144 into 1.08. That's the only if we cross this number, we are eligible to then take profit. So let's say this number is 156 for simplicity's sake again. So if you look at in the 2 year, the hurdle from 100 to 1, so your effective hurdle is actually something which is very, very high, right? Your effective hurdle is 100, it's not 108, it's not 8% for sure, right? And your other question on why should be BSE, why hurdle rate small cap, why should it not be a small cap? If you look at small cap index itself, the returns are, and you take Nifty, you take BSE, either of them. 1 year the return is 70%, the next year it is minus 50%. So, I mean, in a year negative, what you do, right? So, and hurdle rate should be something which, I mean, we don't want to, it's a very nuanced point. But if you keep a very high hurdle rate, then also you are encouraging the fund manager to take extremely high risk, because ultimately that fund manager would want to beat the hurdle as well, right? So if you have kept a very high hurdle rate, then again that would lead to unnecessary risk taking as well. Anyway, we don't want to follow our model. We feel our model is very fair, and that's what we follow. Do you have any positional caps in terms? So I guess the question is on in terms of our position sizing, in terms of how much we put in any stock. I think that's what I understand from the question. So at the time of at cost, that's what we measure. We can go up to maximum 15%, but it's a very rare situation that we go up to 15%. We typically start with anywhere between 2 to 4% and then scale up with time.
Just one thing I would add on that hurdle rate is that it's 8% after plowing back the management fees that is charged. So effective hurdle to begin with becomes almost 10%. And on top of it, what Rohit explained, it just goes on increase.
Okay, so the next question is, what's your opinion about technical analysis? It's useful or not? Some people say technical analysis. Okay, so the question is about, is technical analysis useful? So I restricted to what Rajat and I, and in general what ithought focuses on. So far, all of us, our style is not to follow technical analysis, not to say that it doesn't work. We have a lot of friends in the markets who have done extremely well in by using technical analysis. So I think what we have realized over the course of our time in the market is we need to stick to things that we understand, what we know, and just follow that. Obviously, we can keep adding skills over a period of time, but not try to be everything for everybody. That is something that we feel that can be quite a problematic thing in the markets. We have friends who've done extremely well using technical analysis. We don't use technical analysis in our sort of investing, the investing that we follow. But I think does it work? For few folks, we have seen it work.
So what are the misses? Any maximum drawdown? So at stock level, drawdowns can be, they can be 30, 40, 50%. But if you look at the portfolio level and we talk about the worst drawdown that happened in the recent time was the COVID drawdown, COVID crisis. So during that time, I think portfolios were down by around 25-28%. And the small cap index was down by around 65% during that time. So that has been so this is where I would link this point to what Rohit mentioned during his presentation, that generating alpha during the down markets is the key, because in up market everybody makes money and your risk embedded in a portfolio is exposed only during that time. So yeah, we have been able to do fine in touch wood in every correction so far since the time we started.
So the next question is, considering investing in small caps, you're aiming for multi-baggers. So how do you approach companies which have done, say, 3-5x in the last 2 years, but still fundamentally good? Would you still invest in it, or will you look for something which has not started to run? So good question. So I think there is no silver bullet answer to this. You have to look at in the context of the company's future, the valuation that it trades at. It has to be seen from that perspective. So we saw one example in TD. The stock has gone up significantly. And it still continues to remain a top position for us. So I think it has to be in the context of about the business. But we are, in general, what I'd say is that we are very conscious about valuations. We are not, we don't believe that you should not sell. You should definitely sell. If the valuations go very much out of hand, then we typically will start selling. Typically, we see that from here on, if we cannot make money over a 2-3 year period, then we start to sort of look at exiting. Yeah, so yeah, I think that's what I would like to say. You want to add anything?
One live example we'll share from our own portfolio. One stock we invested, it's an IT company, IT products company. When we invested, it was already 4x up from its bottom. And that too within a short span of you mentioned 2 years, we will say it was less than 1 year, probably it was 4x up. But there were merits to be seen in the company. There was a few changes taking place and a lot of investments had gone into the business, fruits of which were yet to come. So we invested, and from there, stock went on to touch almost 5x in another 2 years or maybe 2.5 years. It is still a 3x from those levels, almost 3x. So yes, it's all a function of how much, what's the business is about and what's the future is. At the same time, I mean, a stock can become 3-4x or whatever number of x it can become. That's a function of how much it has already fallen as well. So the example I have taken here is from the COVID crisis. So that stock was already 4+x when we bought it in less than 1 year time period. So if a stock has fallen a lot, it can come back sharply as well if it's a good company. Yeah, we can move on to the next question.
Okay. What are the sectors you have invested in or bullish about, and how many stocks are there in the portfolio? So the typical number of stocks, so I think we have about 18-20 stocks in the portfolio. But the way we look at it is top 10 would be about 65 to 70%, and then the remaining 10. As I said, we start small and then slowly increase our allocation. So you will have some names where we start with maybe 2-3% allocation, but with the view that this will go up as we get more information, as we get more comfort, as we get more data points as to what our hypothesis it is matching with that. Sectors that we are bullish in. So we like so capital goods continues to be something which we are quite bullish on. We have been very heavily indexed to that. We also like real estate. We also like. So again, I mean, while I've given you some sector names, we typically look at from a bottom-up point of view, what are companies that we like, and eventually what we've seen is that typically what happens is that as you see some of these companies from a micro perspective, you are able to see some sort of theme emerge then. So it's more bottom-up driven rather than having a very sectoral specific view. That's how we operate. You want to add anything, Rajat?
No, nothing.
So the next question is, what are your target returns? So it's a question which we often get, but I don't know whether you can really target any returns, because it's a you I understand the vantage point from your point of view, and I appreciate that question, but I'm just trying to be honest here. You don't really target returns. You manage risks and you protect your downside, and you let the market take care of the returns. We'll be happy if we do 15-18% post fees over a 3-4 year period. So, okay, sorry, your benchmark I'm asking about. Benchmark is BSE 500. This is mandated by SEBI. So that's what we have to follow. Yeah.
Broadly, we would say that we'll just share with you our thought process or our way of working. So at stock level, we always look at minimum of 2x returns, and those 2x returns we would try to see if we can make those returns in 3 to 4 years. And this is the minimum that we are saying. So sometimes you come across opportunities which you think can give you higher returns even in the same time period. So this here would like to highlight 2 points: the kind of returns that you ask, and also the time horizon that we have in every stock at the time of investment. So this is minimum 3 to 4 years is what we look at. Now, some stocks you end up overperforming or underperforming compared to your own expectations, and when things are going fine, you end up owning that stock. And if things go better than what you had expected, because some managers are really phenomenal and they really take the business in the direction that you never imagined, so you end up seeing that business performing year after year or cycle after cycle, because not every business can actually outperform in every cycle. First few slides of the presentations are the testimony to that. Every business goes through its own ups and downs, and hence the share price also goes through ups and downs. So so business is performing cycle after cycle, so you end up owning those stocks for many years. Some of the stocks in our portfolio, we are owning them for more than many years now. I mean, 4 5 years now. So yeah, so just extended your question and the answer to that, that at portfolio, at stock level, this is what we target, and this is our time horizon.
So the next question is, profit sharing will be charged at the time. Yeah, so it will be charged at the end of financial year, not at the time of actual booking of profits. Next question is, what is the strategy to sell? So strategy to sell is broadly a couple of things. One is, if you have gone wrong in your assessment of the business or the people, then you take a call and then you sort of move on. You sell and then move on. We've had those cases in the past, and we've taken a lock, stock, and barrel kind of a view and then moved on. So that's, if you go wrong, that's the first reason why you sell. The second reason which we sort of look at is, as I mentioned, if the outcome has been favorable, and we feel that from here on, if the forward returns in our view are something which are not that attractive, then we sort of take a call to sell. So this is the two reasons why we would broadly sell. Anything else, Rajat, you want to add?
I mean, if there is anything, you find something really good outside your portfolio, which you believe that has, or let's say if you start ranking that new idea in the portfolio idea, so you rank that idea against all your existing ideas, and then you see that the lowest ranked idea is inferior to the new idea. That's when you have to then sell something and then buy that. But at the same time, we'll tell you that in terms of our returns expectations, we don't really, that new idea should give us comfort that it can make much more money than that lowest ranked idea in the portfolio, because something new always, you're studying that company, all your biases come into picture. You are you are looking to invest in that company because you expect to make money. So, saying that existing idea which you have been tracking for some time can give you, let's say, 20% IRR. New idea shouldn't be 20%. It should be more than 20%, way more than 20%, because you have got comfort on the existing idea. You should get similar kind of comfort on the new idea, or that should have higher IRR expectation.
Okay, how to know whether your PMS is suitable for me or not in checklist? I think it's a very good question. I think you should look at a couple of things, I would say. One, I would say whenever you look at us or anybody else for that matter, I think you should focus a lot on the process, how you go, how somebody goes about investing, how somebody goes about managing risks, that part, and you should spend as much time as possible to get comfort around that, and try and see whether the risks that one is taking, the okay with, whether they are matching. And I guess in our kind of a situation, there is going to be slightly more volatility. I started the presentation saying that volatility is not risk. That is something that we are very clear about. If somebody on the other side also should be very clear about, and if those things match, then you can think about. So I would say in terms of checklist, I think focus more on process, focus more on how they have managed downturns, drawdowns, and align your risk taking ability vis-a-vis that of the fund manager that you want to go and back. Anything else that you want to add?
No, that's all.
TD power.
So on cyclicals, next question is about cyclicals. That some cyclicals can be, it can take a lot of time. In the case of TD, we saw it took 3 years. So what is the strategy towards following such cyclical turnaround companies for a longer period of time? So we'll call it a cyclical rather than turnaround, because they are not really into, let's say, financial stress or anything. So first of all, for any kind of cyclical company, what we would like to see is that it's debt free, because cycles can be very long. Some cycles are 1-2 years long, some cycles are 10 years long, and sometimes cycles can be longer than what you are expecting it to be. So ability to survive, capacity to suffer should be there, and that can only come from when you have cash rich balance sheet. So that's one, strong balance sheet and cash flow. So we look at that and the track record over the last, let's say, 10-20 years, how the company performed during the last cycles. Was it able to release the working capital when the revenues are falling? Because in a falling revenue scenario, if your working capital is getting stuck, there are chances that you won't be able to recover them. So good company, you will see that they are recovering the working capital in terms of receivables are coming down, inventory levels are coming down, payables are going up. In a way, they are generating cash. Okay, they're not generating P&L profits, accounting profits, but they are definitely getting the cash back into the system and hence becoming even more cash in terms of balance sheet. So every company, every industry has a different cycle. So you study a company basis these merits. You add the other component of what we discussed at the beginning of the presentation, that management should be good. So if all these things are there, then you start studying that company basis your overall understanding of that business or general sense that you have, that cycle is changing basis. Given we are based in India, we understand a lot of things intuitively because you end up reading those things in the newspaper, magazines. You end up discussing those things with your colleagues and friends in the investing fraternity, or let's say you end up reading those various annual reports or con calls. So you have that sense that a certain industry is going through a certain phase, and within that, when you come across a business which ticks all these points, that's when you start tracking it. Now, if you feel that company or the sector is at an inflection point, or is at in its journey so far, and the valuations are attractive, that's when you make a move. That's when you begin an investment. Look at TD Power. We invested 2%. 2% is nothing if it becomes 4, 5, 6 bagger. It doesn't yield you a lot of money. but 2% was our foot in the door. We were convinced that the cycle is going to change. However, it still took us 2.5, 3 years, because what happened after that cycle, after our investment, ILFS crisis took place. After that, COVID crisis took place. So two major crises, one India specific, one global. So you still don't know when the cycle will really change for the positive. So you begin small, and as and when you get the confirmation, and thanks to these crises, actually confirmations were coming for quarters after quarters, not just 1 month or 1 quarter, quarters after quarters, even years. In the case of TD, at the end of FY20, you could see that there is so much of confirmation. So then you scale it up. So you just track such companies closely, and if you are really convinced, basis all the parameters that you have put in place, and valuation is very important parameter among all, and then you make a move and start tracking them. And there are usual things that you track is profitability, balance sheet improvement, any advances that you're getting from the customer. One company, cyclical company we are invested in, has shown a lot of advances in this particular year. So that is giving us visibility on the next year's revenues. So yes, that is another metric that you track. Yeah, so this is about it. Anything else, Rohit, you want to add?
No. So I think just understanding. I mean, typically the companies that we want to invest in, when they are like cyclical, they need to have some sort of dominance in their category that ensures that if the cycle turns, they will benefit. I mean, that doubt should not be there. And also, I think looking at long range data is very important, not looking at last 3 years or last 5 years, looking at last 10, 20 years, because that gives you much more understanding, much more context about how a business has performed over multiple cycles. So you will be able to deduce a lot of interesting patterns just by looking at long history of financials. And also, as Rajat mentioned, reading old annual reports uh, also really helps, because you will know how the business performed, how the balance sheet changed from one cycle to the other, when did they put up capex, things like that. The next question is, not all ideas go as per expectation. How do you manage failures? So yeah, I think Rajat spoke about it. Definitely not all of them do well. So I think at a portfolio level is what we look at. We try to size the bets uh, uh, in a way which sort of we start small, as I said, and with time we sort of see still mistakes do happen, and there is no escaping that. But it should be mistakes that you can live with, and you can it should not make you go out of the game. So far we've been able to do well. Anything you want to add, Rajat?
So in some cases we have exited very quickly, wherein we saw early signs and we were not comfortable with them. In some cases we were late in understanding them and we had to take slightly bigger loss. But the key is what Rohit mentioned: at portfolio level, you need to come out clean. The allocations where you feel you are stocks where you feel you have, let's say, more unknowns, or you are not really comfortable with certain things, you either get out or you reduce the allocation and bring it to a level where you can tolerate big drawdowns, like even 60, 70, 80% won't kill you. So touch wood, we haven't seen such drawdown so far. But even if that were to happen, allocations will help you there. Managing those, so position sizing will help you there.
So next question is, tell us some useful books and websites. So I can name a few, Rajat, you can name yours. So in terms of books, so the Warren Buffett one is a very
Should
good
we just
book.
put it in the chat box for everybody?
Yeah,
can
that would be
I'll just
best,
do it.
yeah.
In terms of websites, you can mention, Rohit. One is Screener, one is Value Picker. Anything else, Rohit, you
Yeah.
can mention?
Sure, I'll do that. What's the maximum allocation you can go in a single idea? Okay, so I think, as I said, the maximum that we go is up to 15% at cost. This is at cost. We don't look at a market value, not so much we focus on, but at cost we go up to 15%. But it has to be like really something which is a screaming idea, which we understand, which we like. So yeah, that's what we do. The worst idea and what went wrong. So worst idea, I would
So
say maybe I can talk about the one that comes to my mind immediately, and other maybe you want to talk about something. I won't name names, but essentially we invested in a company which was into a branded space, but extremely competitive space. The balance sheet was had deteriorated in terms of the working capital, but they were still cash rich from a cash point of view. So working capital was deteriorating, and the management was clearly mentioning that these are the steps that they will do to improve the working capital. And it sort of made sense. But given the brutality of the industry, it was getting tougher and tougher, and we were not able to understand a few things from the balance sheet point of view, what they were saying, what we were deducing from the numbers. So we invested at, I guess, X. We exited at 0.7 of X. And yeah, I mean, yeah, so brutality of the industry, the sheer competitiveness of the space is something that we ignored, which was visible in the deteriorating balance sheet in terms of working capital. And we thought because it was branded apparel, big market, overall attractiveness towards that space, we sort of got suckered into it. And when we felt that balance sheet is something which is not improving, we sort of exited. We were invested it for a year or two, and we've been tracking this company for about 5-6 years. So it improved, then it went down. We thought it's in terms of balance sheet, I'm saying, we thought it's just a blip. It will come back, and then again it kept on deteriorating and still not revived. So that is something that I would talk about. Anything you want to say, Rajat?
uh, one more name I can talk about. So a company into food colors. They are into food colors, and if you look at their track record up until 2021, they were doing pretty fine, consistent gross margins, a rarity in the chemical space, very good EBITDA margins, and return on capital, balance sheet fantastic, and very good feedback on the promoter. It's a very small cap company. However, company was doing some capex, and they were getting into backward integration to strengthen the supply chain, and they had to put up a lot of capex, which resulted in some debt on the books. And ultimately, what happened, once they completed the capex, they were not able to stabilize it. So company hadn't undertaken such large capex in its history ever. So things took time for them to stabilize. It took them more than a year. However, capex is already done, debt has already been taken, and interest costs have started rolling in. So if you are not producing, you get into trouble because it's a large capex and you are not producing enough to justify that capex, or service the debt, or meet the operating expenditures. So that's where the problems started happening. And to top it, I mean, to top up more of the problems, so demand started reducing, and Chinese players started dumping in an area which never saw dumping from Chinese. China's economy was opening up, and consumption within China was still not enough to absorb the supply in China. So the products which were never coming to Indian markets as Chinese dumping started rolling in. So company got hit from all the sides, and this business is still into the negatives from the time we invested. So this is one idea, which went wrong for us.
So yeah, I guess this is what we had. I mean, in terms of what we wanted to share. I think we're done with all the questions. Just to clarify, you said that according to I'm no, so let me clarify. I'm just saying that going by that indicator, we are not clearly in terms of we're not in a heated environment. Markets can go down anytime, and that's not what I'm saying that the markets are going to go up, if that's what you mean. What I mean is that it's not, even though the markets are at a high level, going by that specific term, I mean that indicator, we are not in a heated environment, is what I want to say. It's right time to additions also. So yeah, I mean, see the way, as I said in the beginning, in one of the slides, that if somebody gives us money, unless we go and ask for that money, if somebody gives us money, we necessarily don't invest it at the time we get it. So that is something I want to point out. If we go and ask specifically for money, so then we definitely will invest that money immediately. So that's something that I want to share. Any other questions we have, or we can close? Poonam, do we have any other questions?
No other questions, Rohit.
Okay, I think we just have one more, which says how much time to deploy the entire corpus. So again, it depends, right? There was one chart which talked about if a client came in March 22, we deployed it fairly fast. I think we had another chart in one of the other webinars where the client started in May 21. The deployment took almost a year. It is driven by the market conditions at that point of time. And by market conditions, I mean the kind of stocks that we are tracking that we want to invest in. So it is driven by that universe. If we are not able to find anything in that universe, then we will not invest. The market may be going up or down. And so it all depends on the ideas that we want to invest in, the pool that we are focusing on, if that is giving us opportunity. And obviously, if the market is correcting a lot, as it was in, let's say, March, April, May, and that was last year, and that drove our very fast deployment. And somebody who will start now, maybe it will not be that accelerated. Will we get buying opportunity during? I hope we do, for all our sake. See, I think again, these kind of macro calls we don't take. We are not going to do crystal ball gazing and say that, oh, because there's an election, things will be bad, or this will happen, so this or something will give us opportunity in terms of market. I think these are all very difficult things to do. We try and stay away from it. And I would say that if you have decided, I think very important to define what you are trying to get out of this exercise. If you want to get returns in 1 year, then probably these things help. If you're looking at probably 3 to 5 years, probably not much of use. I would really urge everybody to really think honestly to themselves that when the times are really bad, are we really able to put in money at that time? Because when the times are bad, it only looks that it will get worse from there. So, I mean, how many of us really put money during March of 2020? That was something purely out of syllabus. None of our generation had ever seen a pandemic, and we were subjected to one. So, what happened then? And so, I think we need to be honest and realistic as to what we can do in terms of these things are out of most people's abilities to guess. So we don't take any cash calls based on such events. Our cash calls are driven by lack of opportunities, something where we have gone wrong, so we sell, or something which has run up way ahead of what we think is the fair value. So then we we'll sell and we'll have cash. And that cash will remain till such time we find something which is interesting. That can be at market highs, that can be at market lows. It doesn't matter.
So just to support this Rohit's answers with some more data points. So 2003 general elections markets, I think took markets went lower circuit down. But on the day of, I think, results, and after that, we know what happened. 2003 to 2008 was the bull market that we probably all of us remember. It was not just the bull market in India, it was global as well. Come to 2008, markets were in upper circuit when the election results came in. Now then look at what happened in the ensuing 5 years. So 2008 to 2013. So elections results and elections time volatility, like Rohit said, if it is 1 year horizon, then fantastic. But like we said, we look at 3 to 4 years minimum when we are entering a company, because that's the amount of time it takes for a business to deliver. And then you can expect, okay, that you can make a doubler in a company. So keeping our time horizon, our philosophy, I think all these things are just events which in the history, if you look at, let's say, if you look at a 20-year charts, you won't be able to figure out which government was the worst, which government was the best, because governments are actually just the enablers. Our economy, thanks to every government, actually they haven't gone back on any reforms. They are just, every government comes and does some sort of reform. This has been the history in our country so far. So if you look at a long-term chart of Indian equities, I think you will see that every chart is just going upwards in a 20-25 year time period. So it becomes irrelevant which government came and with how much majority they came. So these are the things which help your economy move in a certain direction over a long period of time. But since you are focused on very specific stock specific or very specific businesses, which sometimes you can switch also if you think you have got it wrong, or sometimes those businesses are something which are not really affected by even big events which are happening in the economy. We have seen that many times, and COVID was one such occasion when, despite the COVID disruption, some businesses were getting the benefit out of that. So there are businesses which are going to get benefit no matter what. So our job as part owners of a business is to find such businesses and move our money there if we think our business has got it completely wrong and our thesis is wrong. So yeah, so that's about it.
Right. So I think we've answered all the questions that were posed to us. So thank you very much for again spending your precious Saturday with us. If you have any questions, then maybe you can reach out to any of us or reach us at. I think we have the details in the next slide, so you can just post that. Yeah, thank you very much again for spending your time with us. I hope it was useful to all of you.
Thanks everyone.
Thank you all for joining us today. If you have any further questions that you would like us to answer, you can always write to us at pms@ithought.co.in, or you can call us on the number on screen. If you'd like us to, go through Vriddhi as a product, if you'd like to know more, or if you'd like to know more of about the products in the ithought PMS universe, you can always reach out to us and the team will connect with you on that. Thank you so much for joining us today. Thank you.
Thank you. Thank you, guys. Good weekend ahead. Bye.